Hi, this is Richard Flax at MoneyFarm, talking about some of the things that have caught our attention over the past couple of days. We've continued to see this pattern of weak macroeconomic data and financial markets largely taking that information in stride. Yesterday, for instance, we saw a weak unemployment number in the US, initial jobless claims, which came in, as you might imagine, very high and higher than people had expected. But financial markets, equity markets specifically, largely took that in stride. You didn't see a very big reaction to that news. And that suggests that something we've talked about before, that for the most part, while the current slowdown is very, very sharp and very painful, financial markets have broadly factored that in. And the real question for financial markets going forward is how long will this last, and when will we begin to see a recovery underway? Another thing that did create some more volatility were remarks from the US president about a possible agreement between Russia and Saudi Arabia on the oil market. You saw the oil price jump dramatically, some 20% or more, very quickly over the course of the day. And it reflects a couple of things, we think. Firstly, that there's a good amount of pressure and uncertainty in the oil market. And clearly with oil at around $20, $25 a barrel, it's uneconomic for a lot of producers to produce at that level. And secondly, that oil, while we think of it as being a significant input cost, also is a significant source of revenue for a lot of markets, for a lot of countries, and for a lot of companies. And so to begin to see some sort of stability in the oil price, which obviously has fallen by some 60% from where it was at the end of or in middle of February, to see some stability there would be a positive thing. So, a tweet was enough to really make a very big move in the oil price, even if we've yet to see it followed up with anything really concrete. Elsewhere, the other point that we thought was interesting are some of the flows that we've seen into corporate debt. We've seen some very big flows into the corporate debt market, be it through ETFs or funds, and we've seen companies take advantage of that in terms of being able to issue new debt, which they need to do to refinance themselves. But the movement in corporate debt does suggest that all the things that the Federal Reserve and other central banks have done around financial plumbing is beginning to bear fruit, that those markets, those credit markets are very much open for business. And that's something that we think of as a positive in what remains a relatively difficult and volatile environment. Thank you for joining us. Look forward to speaking to you again soon.